Welcome, students. So, now we are going to understand this case of the Veganic with the help of the decision tree analysis. And in the previous class, we just saw the input information which is available with us. So, we have the test marketing cost of the 20 million, and the chances of the success of the test marketing and pilot production are 70%. If it is successful, then we will build the plant and it will require 150 million. And after that, there is every possibility, every likelihood that the demand, if it is high, means normally it is expected to be high, and if it is high, so it will give a cash inflow of the 30 million for next 20 years. But if it is moderate, then it will be 20 millions of the cash flow for the next 20 years. And chances of demand being high would be 60%, and being moderate, that is 40%. There is no chance of demand being low or very low. So finally the product is going to be successful, but only the difference is whether demand is high or demand is moderate. That will be seen in future practically when the product goes for the test marketing, and finally we take a call to make this investment. So final way or the best way of looking at this kind of the situation and analyzing about the monetary outcome as well as the risk associated to this kind of the investment and this kind of the projects is the decision tree. And with the help of decision tree, we will understand that how we can analyze this case of the Veganic and take a final call whether to make the investment in this particular product of electrical moped or a small scooter or not. So as we see here, this decision tree is already developed, right? So we have two things here. First thing is the D's, and then we have the C's, right? So D's are the decision points and C's are the chance points, as we discussed in the conceptual part also. So first we are taking a decision, maybe, or maybe we are zeroing in on a particular thing or this particular decision. This is called as a D1. When we are taking a call, we are taking a decision, that is D1. That means because we have already conceived the product, we have already developed the product, and we know it that how it can be manufactured, and already we have developed the prototype also, and all the technical aspects have been tested, and now the product is ready to be taken to the market. But before that, we have to conduct we have to go for the pilot production and test marketing, so that we can test the water in the market, and finally we can go for the commercial production. So the first decision is, after conceiving the idea, developing the product and testing it at the plant level, now we have to take a decision, the first decision, that whether we should carry out the pilot production and test marketing or not, right? If we go for this decision, that is D1, so it means the investment requirements 20 million. But if you drop it, that no, we will not go for manufacturing this product and we will not go for the pilot production or test marketing, so you can go for the second alternative, that is do nothing and abandon the product or maybe the total development of the product and look for the alternative. So if we go for this, if we take D1 decision D1, then we will go for yes, manufacturing of the product at the mass scale. But before that, the first decision is to go for the pilot production and test marketing, and the requirement of the investment requirement is 20 millions. The cash outflow is going to be 20 million. Now, if you abandon this decision and you take this decision, then what are the chances of success? So it is 70% probability of being success, the test marketing and pilot production being successful. The probability is 70%, and of being a failure, the probability is that is the 30%. So under the C1, the chance point, under the chance point C1, we have the two say possibilities. One is C11 and one is a C12. C11 says that if the product becomes successful or the pilot production and test marketing becomes successful, the chances are 70%, and maybe it will be a failure, the chances are 30%. Now, if we are going to accept this, the 30% probability we are going to accept this, then we are going to stop here and we are not going to proceed further. But because chances of being successful are 70%, so we are going with the next part and we are going to the decision level 2, that is D2. And if we are going with this 70% of the success probability to the decision 2, then certainly we would be required to make this investment of the 100 million rupees to invest into the plant for manufacturing the product at the commercial level and starting the commercial production. So either you can take the decision D21 or you can take the decision D22. If you take the decision D22, then you have to stop it and you have not to make any investment, and you will not go for say giving the shape to the product. If we go with this decision D21, right? Decision D21, and make an investment of 150 million. So what are the chances of demand of the product in the market? There is a probability of 60% that the demand for the product will be high, and if it is high, then the cash flow will be 30 million annually for the next 20 years. And in any case, if the demand is moderate, then the probability of being moderate is 40%, and in that case the demand would be, or sales would be, or the cash flows would be 20 millions for the next 20 years. So in case of the demand being high, for which we have a probability of 60%, annual cash flows would be 30 million. And if the demand is moderate, but the chances of which being 40%, so the annual cash flow would be 20 million for the next 20 years. So this is a decision tree we have analysis. We have developed, we have delineated at the moment, and on the basis of this decision tree, and on the basis of the decision points and chance points reflected in this decision tree, we will have to make now the practical evaluation, and finally the quantitative evaluation we have to do, and finally try to find out that what is the expected monetary value being generated by the project. And if the expected monetary value of the accept decision is more than the reject decision, then we will accept the decision and we will go ahead with the alternative of manufacturing the product and taking it to the market. But if the EMB is, in case of the reject decision is more, in that case we will reject the decision and we will not go for the commercial production. So now we will, as I told you in the conceptual part of the discussion, that now we will start from the right hand side of the decision tree. So start at the right hand end of the tree and calculate the EMB, that is the expected monetary value, at the chance point C. At the chance point C, and the chance point C2 is at the chance point C2. So the chance point C2 says that we will have to evaluate it numerically, and finally we will have to move to the leftward in the decision tree. So expected monetary value at C2, it means that if there is a high demand in the market for the product, the probability of which is the 60%, and sales, and finally the cash flow expected from this product would be 30 million for a period of how many? 30 million for a period of 20 years, and our discount rate we are using is the 12%. And if there is a moderate demand, the probability of which is just 40%, the cash flow will be 20 millions for the 20 years period of time, and to be discounted at the 12%. So finally, at this probabilistic estimates, 60% of high demand and 40% of moderate demand, 30 million of the cash flow for next 20 years under the high demand, and 20 millions of the cash flow for the next 20 years for the 20 millions. So 40% probability of the 20 millions of the cash flow for the next 20 years under the moderate demand. So EMB works out as the 194.2 million. EMB at the C2, the chance point 2 is 194.2 million. This we are working out as EMB. And finally, we will have to evaluate this chance now with the help of the decision we are going to take here. So we have to now evaluate the EMB of the decision alternative at the D2. So what was the D2? D2 was this, that make an investment of the 150 millions. So if you're going to have at the chance point C2 the expected monetary value EMB of the 194.2 million, and at the D2 decision level D2, if you see here the investment requirement, so investment requirement is 150 million. So from the expected monetary value of 194.2 million, which is going to be generated by the project after addressing the probabilistic this estimates of 60 and 40%. So this 194.2 millions of the EMB is going to be generated, and out of that, even if we subtract the investment of the 150 million, which is at the D21 level, so finally expected monetary value generated by the product or by the project is going to be 44.2 million, which is significantly positive and which is significantly better and acceptable. But if you stop it, so finally your expected monetary value would be 0, and you would have to abandon the project, or you have to abandon the total investment option. So similarly, now we have to go for to select one out of the two, and in this case we will have to understand it that since the expected monetary value is very positive, significantly positive, so we will have to select this D21. This is D21 of making investment of 150 million, and we have to truncate, we have to drop this D22, and finally we have to go ahead with, because the expected monetary value of D21 is greater than the expected monetary value of D22. So we will accept the decision of making investment of 150 million in the commercial production. So we will go for the commercial production and we will have the positive expected monetary value from the project. Now, next step involved in this case is that we have to calculate now the expected monetary value at the C1 that comes next in the total, say, roll backward. So, in this case, if you calculate the expected monetary value at the C1, so what is the C1? If you look at the C1 here, so C1 says that if we go for the test marketing and the pilot production, so probability of being successful is 70% and probability of being failure is 30%. So C11 says success with 70% probability and C12 says the failure with the 30% of the probability. So we will have to evaluate this chance also, which is called as the chance or the chance point C1. So expected monetary value at C1 is how much? So we are going to take here is that is the EMB at the D. When you talk about the EMB at the say D21 is going to be 44.2. So it has to be evaluated with regard to the chance 1, that is a C1. So final value, that is a 70% of being successful is 70% probability into 44.2, that is expected monetary value at decision 2-1 at the decision 2-1, and plus the zero monetary value with the probabilistic estimate of the 30. So final say expected monetary value at the C1 is going to be 30.9 million. And finally what we are going to do is evaluate the EMB of the decision alternative at the D1, that is the first stage. So we are starting from the right hand side, we are moving to the first step, that is in the last extreme step in the left hand side, and that step in the extreme step in the left hand side was the D1. So we have the two options here, that we had the D11 and this was D11 and this was D12. So when you move to the extreme left in this evaluation process, so finally we can say that D11 says that carry out the pilot production and go for the test marketing at a cost of the 20 million rupees. So what is the expected monetary value of the C1, that is 30.9 million, and when we go for the test marketing and spend 20 million, so final value of the expected market value of the D11 is the 10.9 million, which is still a positive value, very effective value, very positive value. And if we do not do anything, if we abandon the decision, so finally the value of decision 1-2 D12 will be 0. So better it is that we should go for making the production or initially starting the test marketing, go for the pilot production, go for the test marketing, and then finally invest the asset amount required 150 million for building the plant, and then start manufacturing the product and taking it to the market, and try to make it happen that the demand for the product is quite high, for which already the chances are significantly high. You can say the chances of demand being high are 60%, right? Chances of demand being high are 60%. So if you further increase the chances of high demand from 60 to 70%, we would be more than sure. And if the demand is high for the product, so significant cash flow would be available for the next 20 years. And that cash flow means we are expecting 30 millions of the cash flow, annual cash flow for the next 20 years. But in any case, if the probability goes up from 60 to 70%, and we are more than sure that yes, this 30 millions of the cash flow, annual cash flow for the next 20 years is going to be there, then certainly the project is going to generate a significant positive NPV and IRR certainly more than the required rate of return. Expected IRR would be more than the required rate of return. So finally, we will have to take a call, make the investment, and we will have to go with the project and finally start manufacturing the product, that is the electric moped, right? So finally, we can conclude here that based on the above evaluation, we find that the optimal decision strategy is as follows. Choose D11, right? Choose D11. D11 is carry out the pilot production and the market test or the test marketing at the decision point D1 and wait for the outcome at the chance point C1, right? Go ahead with this. Means take the risk, go ahead with this, go for the pilot production and test marketing at D1, accept the decision D11, and and wait for the outcome at the chance point C1, right? If the outcome at the C1 is C11, that is success. Outcome at the C1 is C11, that is success. So invest 150 million. And if the outcome at C1 is C12, the failure, then do not make any investment. So finally, we can say here that initial analysis tells us that when we have developed the decision tree and moved from the right to the left, so we have found maybe till the last step that the expected monetary value is going to be positive by about close to 11 million rupees, and that too after making the investment of 150 million and having the sales sizable amount of the sales, means at the given probabilities. So there is no reason that the project would be a failure or would not be a successful. So we should take this much of the risk because largely we have visualized the risk in advance, foreseen that what is going to happen with the expected monetary value of the project. So we should take a decision in favor of, right, we should take a decision in favor of making this investment of 20 million and carry out the pilot production and test marketing. We are quite hopeful, up to 70% we are hopeful that it will be a successful decision and successful outcome, means the decision would come out with a successful outcome. And finally we should make investment of 150 millions for building the plant and going for the commercial production, and try to make the efforts that demand for the product is quite high, and we are able to have this 30 millions of the annual cash flow for the next 20 years. If all that we are able to do that, it's a win-win situation for all the stakeholders, and project is going to be very successful option, right? So this is all you can say, that these are the different techniques. This was the final technique or the last technique of the risk analysis of the projects. So a decision tree analysis is a very valid tool, though it's a little complex and little cumbersome, right? It's a lengthier also and requires a good expertise also for making this investment, but or evaluating any investment or the risk associated to that investment. So it's a little cumbersome as a lengthier, but there is no problem. You can take a chance and you can use at least two techniques together. You can take one, use maybe in the first case you can use the sensitivity analysis, and if you wanted to be more sure about, you can use either the simulation or the decision tree analysis. And it can be used, simulation or a decision tree analysis can be used as the supplementary techniques of the risk analysis associated to the projects. And finally we can conclude on the basis of this entire risk analysis of the expected project investment, that how the investment is going to behave, what is going to be the outcome, and whether that investment or that project is going to be a successful venture or not. So risk analysis is a very important and integral part of the overall project management. And before making the investment in the practical sense, you should make all these estimates and evaluations. So after this cash flow analysis and the say calculating the or learning about calculating the discount factor or maybe the cost of capital, risk analysis is the second important requirement to make sure or to understand or to be sure about that NPV of the project is going to be positive, and the expected rate of return would be more than the required rate of return. So this is the sixth technique of the risk analysis of the capital investment projects or the long-term investment projects. And this is quite helpful, very interesting, little cumbersome, requires more capabilities, expertise and data. But the results are very supportive, very good. And on the basis of these results, you can take the final call whether to make the investment in this project or not. Now, we will discuss some other important aspects of the corporate risk analysis, and these important say points are, because till now we were talking about the single project analysis, and now we'll be talking about the corporate risk analysis. So some important points are here to be talked about in nutshell, not in detail. So in this case we can say is that a project corporate risk is the contribution of the new venture to the overall risk of the firm. So till now we talked about the single standalone project and risk analysis of the standalone project. Now we are going to talk about the corporate risk analysis. So in this corporate risk analysis, we are going to find out is that, for example, if this is going to be a venture by an existing firm, so it can be quite likely that this new venture, being a riskier investment, is going to disturb the overall say risk profile of the firm as a whole. So, in the corporate risk analysis, you do a contextual analysis, and in the context of the existing firm and its cash flows and its risk profile, you evaluate the new investment proposal and try to see that when we make this new investment, how it is going to behave and going to impact the financial health of the existing firms. So, this is the one part of the story that we evaluate, we try to find out that the new investment is going to affect the health of the firm in what way. And second important thing is that on a standalone basis, a project may be risky. On a standalone basis, a project may be risky, but if its returns are not highly correlated, but if its returns are not highly correlated or even better negatively correlated with the returns on the other projects of the firm, its corporate risk tends to be low. It means we have to use this project new investment option in the form of the diversification or for using the weapon of diversification. So it may be possible that cash flows of the existing projects or the firm as a whole are moving in one direction, whereas the cash flow of this project is moving in the other direction. So, in that way, if that happens, so the benefits of the diversifications can be enjoyed by the firm. So, in a situation when the cash flow of the existing firms are going low, the cash flow of the new investment may be going high, right? So it means the firm is safe, and that way it's going to add the positive value for the firm. And in any case, the project is going to be a riskier proposition, but the existing firm's cash flows are going to be high. So that is also going to be a good situation for the firm, because some riskier element coming from the new investment can be taken care of by the positive and the fastly growing cash flow from the existing projects of the firm. So we have to see that the cash flows of the new venture must be negatively associated with the cash flows of the existing projects of the firm. If it happens, then it's a safer investment, because the benefit of diversification would be possible to be enjoyed by the firm. And in case of some negative results from the new investment, positive results of the existing projects will take care. And in case of some negative results from the existing projects of the firm, positive results from the new venture would be helpful to make it positive, the overall impact as positive. And finally, the risk of the firm as a whole can be minimized or can be mitigated or can be managed. Now, how we can manage the risk in the real term? So, managing the risk in the real scenario, or how normally the firms manage the risk in the real scenario. So, here are the important points. First thing is fixed and variable cost. So, when they go for assessing the cost, they manage the fixed and variable cost, because fixed cost to some extent remains fixed, but the variable cost is controllable cost. So, they try to control the variable cost and the overall cost of the project. If it is possible, then certainly the cash flows would be manageable and would certainly become positive. Pricing strategy: they price the product in such a manner that it's easy to sneak the product in the market, to take the product to the market, and they price it as per the paying capacity of the market, and they add the attributes in the product as per the pricing they are going to have from the market, and finally the product may be successful. Next thing is sequential investment. So, good companies do not make the total investment in one go. They start manufacturing at the smaller level and then they increase the investment in the sequential manner. So, that keeps the investment safer. Improving information before making the investment in the real sense. All kind of information, maybe with regard to the market and demand analysis, technical analysis, financial analysis, or even the risk analysis. They generate all the analysis, all the information, and finally take the call and make the investment. Then financial leverage. Yes, it's a very important component. The firms who want to manage the risk of the firm or the new projects carefully, they keep the element of the borrowed capital as low as possible, the financial leverage. Borrowed capital means financial leverage as low as possible, so that the fixed liabilities component is very low and they are able to manage the cash flows as well as the payment to the external stakeholders, and they always keep it in the manageable form. They keep all the assets largely insured. So, insurance is the next alternative. And long term arrangements. So, long term arrangements is a very important thing with regard to the inputs, or maybe out for the outputs also. When inputs, they are going to arrange the raw material, maybe the technology, machinery, raw material, or any other kind of inputs, utilities. even in case of the human resources. So the good firms make the long term arrangements so the cost can be managed. And as far as the output is concerned, for selling that output in the market, to the buying firms, they make the long term arrangements so that they have not to look for the buyers every time, and they have the ready made buyers and they are manufacturing for them on the long term basis. Sometimes we can go for the strategic alliances also, that when we are entering into a new market, we should enter in the form of a strategic alliance with an existing player in that market, so that the ups and downs of the new market can be well understood with the help of an existing player in the markets. Derivatives are another technique. You can make use of derivatives, and with the help of derivatives, we can manage the risk. And firms are managing the risk with the help of the derivatives in the practical sense. You can read this literature on derivatives, how the derivatives are helping to mitigate the risk, and it's a very important and common measure of reducing the project risk. So, selecting the project under the risk is basically based upon the judgmental evaluation. Normally, people involve the experts, and their judgments play a very critical role. We always take the help of a payback period also, and payback period always helps us to understand, because it says that risk is a function of the time. So, any project to be lesser in risk, we always have to keep the payback period, or we have to select the investment options, those investment options where the payback period is lower comparatively, because longer the payback period, it may entail more amount of the risk. So always select the investment options which are, say, having the shorter payback period. And you can increase the discount rate also. So discount rate, if you increase the discount rate, so in that case, you will be requiring the, say, higher cash flows to make the NPV positive. So you have to work very hard, and even the cash flows are not up to that mark, because our discount rate is very high. Practically this much of the discount rate is not going to be there, so project will be manageable and the risk will be manageable. Next thing is the certainty equivalent method. So we can go for this method, certainty equivalent method, and we can manage the risk, or normally firms manage the risk with the help of this method. So this method is very simple to understand, that say for example, you have this example of one person called Mohan, who is presented a lottery ticket, and the probabilities of the outcome of that lottery tickets are in these two forms. Either it can be 1000, he can get the lottery, say, ticket, maybe the prize money of 1000, probability of that is 30%, and he may also get prize money as 5000, probability of that is 70%. So now if you work out the product of these two probabilities as well as these two values, this will come up as something like as 3800 rupees, which is a probabilistic outcome, right? Which is not a certain outcome. But if you ask Mohan that, for example, you forget this 3800 rupees for a moment. If you want to be sure that I should get minimum of the prize money in all cases, what would be that amount? So he would say that I would be happy, I would be satisfied if I am getting 3000 rupees, and in that case I can forget this 5000 also, I can forget this 1000 also, and I can forget this 3800 also. So that 3000 rupees of the expectations of Mr. Mohan is representing the certainty equivalent coefficient, or maybe the certainty equivalent value, not coefficient. Coefficient we will work out. So that is a certainty equivalent amount that he wanted to be sure with, and he wanted to be satisfied with, that 3000, I am happy with the 3000 rupees, and 3000 rupees are available to me from this lottery, I'll be very happy. So the lottery expected outcome is going to be 3800 rupees, his certainty equivalent value is 3000 rupees. So with the help of this certainty equivalent value and the expected value from the lottery ticket, we will calculate the certainty equivalent coefficient, which in this case comes up as 0.79, which is called as the certainty equivalent coefficient. So largely we work out, to manage the risk, we work out this kind of the coefficients, and looking at the value of the coefficient. If the value of the coefficient is higher, it means the risk associated to the project is lower. But if the value of the coefficient is lower, then the risk associated to the project is high. So we have to take the call accordingly. And it primarily reflects two important things: variability of the outcomes, because there is a variability in the outcomes, right? And an entrepreneur's attitude towards the risk. So if the entrepreneur is prone to the risk, of he's ready to take any kind of the risk. So he will not accept this 3000 rupees like Mohan, as he's a risk averse person, so he's happy with 3000 rupees. He doesn't want to go for or wait for 3800 rupees. But if an entrepreneur is a risk pro and he wanted to take the risk, then in that case, for example, if he is the Mohan, he will not be satisfied with this 3000 rupees. He is ready to take the risk, and he says that if the expected value of this investment is 3800 rupees, I will wait for that. I will take the risk and I will go for earning this 3800 rupees. So it all depends upon these factors. If the variability is high, you should accept the value as per the certainty equivalent coefficient. But if the variability in the cash flows is low, in that case, I think you can wait for, and finally you can say that whatever the outcome of the project is, I am ready to take the risk and I will go for it. So normally this coefficient, when you talk about, is when this coefficient ranges from 0 to 1. When the CEC, the certainty equivalent coefficient, is 1, so the level of risk is very, very low, almost a negligible risk. But when the value of this is closer to 0, it means the risk involved in the project is very, very high. So, for example, if you are given this certainty equivalent coefficient from any source, if you could get it, that for making the investment of 1 lakh rupees in any project where the CEC, certainty equivalent coefficient, is 0.8, so finally you can expect that the cash flow means the certain cash flows, certainty equivalent cash flows coming out of that venture would be 80,000 rupees. So, finally, in the essence, you can say that certainty equivalent coefficient is a valuable tool for making informed investment decisions under uncertainties by quantifying the impact of the risk on the expected cash flows. So, if you are risk pro, you will wait for the outcome and you will not get influenced by any kind of the maybe certainty equivalent amount. But if you are risk averse, you would say that I will expect the certainty equivalent amount and I will not wait for the outcome of the project. So, accordingly, in the real life also, when you go to make investments, that investment you have to make in a sequential manner and try to see what is the outcome in the first phase, and then try to increase the investment like that, so that whatever the cash flows coming out of that investment are, they are more stable cash flows and certainty equivalent say cash flows, and you are happy with that because the element of certainty associated with those cash flows is high, and we are not venturing into a venture where we are making huge investment in one go and taking huge amount of the risk. We were not knowing with certainty that how much cash flow was expected to be there from that proposal, and finally we end up with the very serious issue or the serious problem. That should not be done. So either you satisfied with the certain values using this certainty equivalent method, or if you are not satisfied with that, you are little risk pro, then you calculate this CEC coefficient of the say certainty equivalent, and then finally try to find out the cash flows and the final maybe the certainty equivalent value of the cash flows, and finally you can decide whether you should make the investment in the project, and if you want to make investment in the project, in what way you want to make the investment in the project. You want to start with a small scale, then you want to gradually increase the investment over a period of time, so that the certainty associated to the project and its cash flows remains high and manageable. Practically, when people are using this risk analysis practically, so they are going for the conservative estimates of the revenue. The revenue may be expected to be very high because product is going to be successful, but people remain conservative. They keep safety margins in cost little sufficiently high, so that they can say that normally if the cost is going to be 10 rupees, they say no, cost is going to be 12 rupees. So they're keeping the safety margins in the cost. They're going for the flexible investment yardsticks that sometimes they change the internal rate of return, sometimes they change the NPV requirements for them, and finally they decide on the projects which are going to give them the NPVs or IRRs as per their expectations. And they sometimes go for the accepting developing an index which is called as the overall certainty index, and sometimes they go for the 3-point based judgmental estimates also. So 3-point estimates are developing 3 scenarios: most expected, optimistic and pessimistic. So most optimum or the expected scenario, pessimistic scenario, and the optimistic scenario, and finally they take the call on the basis of these 3 points. But as far as the question of developing a certainty index is concerned, we have tried to develop this concept and explain this method here. We know on the basis of our experience or with the help of some consultants in the market, we try to assign some certainty to some of the inputs required for the project. For example, we can say that raw material is 70%, we are sure that it is available as per our expectations. Power is also available up to 60%, we are sure as per our expectations. And freedom for the competition is also up to 80%, we are sure that it's going to be there. So when you develop the overall certainty index out of it, so you are going to be say that it is 70, which is 70%. And with 70% of overall certainty index, when you go to the market, start manufacturing the product or giving a shape to the project, it's certainly going to be very successful venture. And largely, maybe at the end of the day, the investment is going to be a better investment, a good investment, and not a bad investment. And finally, if you see a survey results here, as I was talking to you, that which method is commonly used in the industry. So there is one survey conducted in the past by one professor of this IIM, Mr. Manoj Anand, and he has come out with very good, interesting outcomes. So he says that 90% of the firms, as per his survey results, as per his say data, what he's collected. So out of the total companies he surveyed, 90% of the companies, more than 90% of companies are using the sensitivity analysis. 61% or 62% companies are using scenario analysis. Then 31% companies are using risk adjusted discount rates. Very low companies are using, that is 12 and 8%, the decision tree and Monte Carlo, because these two techniques are little complex. It requires more resources, more expertise, more capabilities, and results are not better or superior than sensitivity or scenario analysis. So better it is to go for sensitivity and scenario analysis. And these survey results also prove that most of the firms are using these two methods, sensitivity and scenario analysis, and depending less on the more technical, or you call it as the advanced techniques like the decision tree and the simulation analysis. And last thing, before concluding the discussion on the risk analysis of the projects, we can say that how the financial institutions analyze the investment proposals. So they use three important indicators. They use several indicators, but the three important indicators are there for them. First is they use the break-even point, right? They want to calculate the company they want to fund, or the project they want to fund, or they want to provide the investment. So they calculate the break-even point for them. They calculate the accounting break-even point also. They calculate the financial break-even point also, because after the break-even point, the profitability will start. Second thing, they calculate the debt service coverage ratio, and next thing they calculate the fixed asset coverage ratio. So debt service coverage ratio has in the numerator interest plus the principal component, and on the say denominator they have the total say profit after tax available with them. They can take the profit after tax, and in the numerator they can take the total external obligations. And here in this case, when you calculate the fixed asset coverage ratio, so they take on the fixed asset in the numerator, and in the denominator they take the total debt. So they want to find out that out of the total external obligations, how much fixed assets are going to be funded. And apart from these three things, break-even point and debt service coverage ratio and fixed asset coverage ratio, they conduct the sensitivity analysis also before providing the funds to the new ventures or the new investment activities or new investment options. And break-even point, when they calculate the break-even point normally at the level of the say targeted capacity. When the firm reaches at the targeted or expected capacity, which is normally within a period of 3 to 4 years, either at the end of the third year or in the fourth year. So when the company reaches at the target capacity utilization, then they calculate the break-even point, try to find out that at the targeted capacity utilization at the end of the third year, has the firm reached at the break-even point or not. If the firm is going to reach at the break-even point when they are going to use the targeted or expected capacity, then it's fine. And normally that is at the end of the third or in the fourth year maximum. But if any firm, if it is not is reaching up to the break-even point, even after exhausting the targeted capacity or expected level of the capacity utilization, and at the end of the third year or in the fourth year, then it's not a worthwhile investment. So sometimes they may hesitate to make investment. These financial institutions can hesitate to provide the finance for these ventures or those say projects or those investment options. So finally, the break even point which they calculate means they relate it to the capacity utilization. So it is called as the break even point capacity utilization. Means at break even point, what is the capacity of the firm utilized? Has the targeted capacity or expected capacity utilization been done by the firm at the break even sales or not, or vice versa? Means you can say that even after exhausting the targeted or expected capacity of the plant, has the firm reached at the break even point or not? If the firm has reached at the break even point, then it's fine. So you have to see two things: capacity utilization and period of time, 3 years or maximum 4 years. So if they reach at the by using the targeted capacity by the end of the third or maybe the fourth year at the break even point, then it's a useful investment for the financial institutions. Otherwise, it's not a useful investment for them. So you have to make sure, if you are going to be entrepreneur in any case, try to be on the break even point by the end of the third year or maximum by the fourth year. Only then you can expect this investment from the external sources. Otherwise, you have to rely upon the internal sources only, and external funds may not be available to the entrepreneur because the project may be little more riskier. So with this, we will stop here the discussion with regard to the risk analysis of the capital investment projects or the new projects or the new ventures. And so far we discussed all the techniques which were there to deal with the risk of the standalone projects or the corporate risk or maybe the contextual risk. And there we try to see that how practically this risk assessment is done. And it's very important component of the overall project management. So before making any investment in the market, it's better to go for the complete risk analysis so that we are sure what is going to happen with the investment or with this project, maybe which we are going to give the shape in the time to come. And finally, it is safer from all kind of the risk. Maybe it's the operating risk or a financial risk. And finally, it's going to be a successful investment. With these words, I'm going to stop here. And in the next class, we will talk about the next concept. Till then, thank you very much.